if you're going to have an inheritance tax, then you should treat as many assets as similarly as possible, because if you don't, you both introduce inequity and you introduce quite a lot of inefficiency because of the way that people hold on to assets or buy assets or increase the value of the assets because of the inheritance tax treatment. Hello and welcome to this edition of the IFS Zooms In. I'm Paul Johnson and I'm Director of the Institute for Fiscal Studies. And today we're going to talk about inheritance tax. It's not one of the biggest taxes by any means, but it's certainly one of the more controversial. And in the recent budget, Chancellor Rachel Reeves announced £40 billion worth of tax increases, pushing tax as a share of national income to an all-time high in this country. And just a really small bit of that, maybe just 6% of the total, came from an increase in inheritance tax. And just a small bit of that came from farmers, or will come from farmers. And yet, it's inheritance tax, and particularly that effect on farmers, which has dominated the news headlines ever since. And perhaps that shouldn't be so surprising, given that surveys regularly show that inheritance tax is much the most unpopular tax, seen as unfair by many, many people. And yet, as I say, it really isn't one of the big ones. So, maybe not big economically, but it's absolutely big in the news. It's absolutely big in people's minds. And I suspect it's not terribly well understood. So, to discuss how it actually works and how it actually changed in the budgets and who might be affected and whether it was a good idea and something about the size of inheritance tax, I'm joined today by Helen Miller, Deputy Director here at IFS, and by David Sturrock, my colleague here, who focuses quite a lot on inheritances and inheritance tax. Well, let's start just by looking at some of the basics. What is inheritance tax? How does it work? Who pays it? Let's start with that before we get to any of the changes. So, Helen, I think you're going to give us some of the basics on what it is and how it works.
Yeah, so starting at a very high level, inheritance tax is a tax on the net assets of an estate. So if you die, you'll add up the value of all of your assets minus any debts you have, and that's the value of your estate. But most people don't end up paying inheritance tax, and that's for a few reasons. Everyone gets to pass on at least £325,000 tax-free. You can pass on another £175,000 if you're passing a home to your main descendants. Put that together, and with some very simple planning, a couple can often pass on £1 million before you have to worry about inheritance tax.
That's because you can add them up between a couple. If I die, leave it to my wife, and then she dies, the whole lot is added together and put the house bit in, and you've got £1 million tax-free.
Exactly. So most people when they die don't have £1 million of assets to be passing on. So as most people don't have to worry about this system. In addition to that, in the current system, before we think about the budget changes, people could pass on agricultural land and property and business property completely free of tax. To put that all together, and actually a very small number of estates, something like 4 or 5% of estates, that's 1 in 20, end up paying inheritance tax. It's less than 1% of government revenue. So as you said at the top, a pretty small tax. It is rising over time, might come back to that. Basically, as wealth gets more important in the economy, we are getting more from inheritance tax, but it will always be a small tax. Perhaps two things on how we stack up internationally. I think one way in which we're unusual is that it is a tax on estates. Most countries, if they have an inheritance tax, it's more like they have it on individuals who are inheriting, so on the person inheriting rather than on the estate. So we stand out a little bit unusually there.
And that seems fairer, because if I inherit lots of bits, then, or lots of big bits, it might be reasonable to tax me a lot. But if, like me, you're leaving your estate, I will be leaving it to 4 children, they're going to pay as much tax as if I'd left it to 1.
Yeah, I also think I think people find that system fairer when they think about it. If you think about the kind of narrative that you've saved up over your life, you've got a pot of money you want to bequeath to your children, the government's taking it, I think that feels unfairer to people than if you take 2 people, one's earned £50,000, one's inherited £50,000, and one gets to be taxed on their earnings and not taxed on their inheritances. So I think that kind of different way of looking at it also sort of maps into how people feel about the inheritance tax. But either way, the UK tax is a tax on estates. Another sort of fun fact for you, conditional having an inheritance tax, not all countries do, but compared to those who do have one, we have a relatively low share of transfers being taxed, but those that are taxed are often taxed at a relatively high rate. So our rate is relatively high.
So it's a 40% rate. So as soon as you start paying anything, it's at 40%. So that is quite high. So anything above that allowance, you lose almost, or your descendants lose almost half of it.
Yeah. To add that up, and in revenue terms, we're sort of to the middle upper pat of the pack in terms of internationally how much revenue we get from inheritance tax.
So 7 billion is a very small number. We get £1 trillion basically in taxes, and only 7 billion of that. So what's that?
0.7, I think, percent of revenue.
0.7%, yes.
Of revenue.
0.7% of revenue. It's not 0.07. I struggle with my zeros. It's 0.7% of revenue, or actually a bit less now, comes from inheritance tax. So it's really not a biggie. It's interesting what you say there. A lot of countries, it's very unusual. I mean, basically every country has an income tax, a VAT, a corporation tax, but quite a lot of countries don't even have an inheritance tax.
Yep, there are a whole bunch of countries that don't have one, and some countries that have, I think, got rid of them as well, who've had them, tried them, and decided they don't want them anymore. So there's definitely a big international experience on that.
Yeah, I'd say, if anything, the direction of travel across the world is probably getting rid of inheritance tax or taking people out of it. So maybe the UK in this budget is moving against the flow of the rest of the world and general tendencies by bringing more people into inheritance tax.
Conditioned on the countries that do have an inheritance tax, we also stand out in that we have particularly high reliefs on agricultural land and business property. So if you have an inheritance tax out there in the world, there are plenty of countries that have some reliefs for agricultural land and business property, but ours stand out as particularly generous. It's kind of, you can pass on 100% of that asset completely free of inheritance tax. That is particularly unusual internationally.
Let me pick up on this. It's kind of surprising in a way, in a world where I think people quite worry about social mobility, they worry about equality of opportunity. And yet, David, you're describing a world in which countries are moving away from inheritance tax, which you might think was going in that opposite direction. Is that because they just can't make it work properly and fairly? Because one of the things that we know about a British inheritance tax, it was true, my predecessor, but several wrote a brilliant book about tax in which he said that essentially, if you're healthy, wealthy and well advised, you basically don't need to pay inheritance tax. If you're properly wealthy, you can give most of it away well before you die if you're reasonably healthy. You can set up trusts and do all sorts of clever things which you need lawyers to tell you about, or you could have bought agricultural land or business assets or what have you.
Or so just pass it on to your family 7 years before you die. I mean, you don't even necessarily need the sexier avoidance mechanisms. Actually, there's some pretty simple stuff that helps you out here.
You can't do that if you've got an owner-occupied house and continue to live in it. So if like most of us, most of your wealth is in the house you live in, it's difficult. If you're properly rich, you can give loads of it away a lot earlier.
Yeah, and that might underlie one of the reasons why people, or some people anyway, don't like this tax. They kind of think if you're super wealthy, so a lot of your wealth is held up in shares or something that you can just sell and pass on to your kids when you're getting on, then you're not going to have to pay this tax. Whereas, like you say, you're kind of more typical person, they're not going to be able to pass on their house. They need to live in it until they pass away, and so they're going to have to pay the tax. There could be other reasons, though. I think there are other reasons why people maybe don't like this tax. I think that there's maybe a bit of a disconnect between perceptions and reality. Some of that is maybe a legitimate uncertainty about, here I am, I've accumulated my wealth, I'm in my 60s, maybe I'm well over that effective £1 million threshold. Now, maybe I'm going to spend down some of that wealth, but I'm not quite sure how much. Maybe the government's going to increase the thresholds by the time I get to passing on that wealth, and so I'm not actually going to be over the threshold when it arises, but I don't really know where I stand. And so a lot more people think that they're going to pay the tax. I think a recent poll after the budget said that 40% of people think that they will pay inheritance tax when, the current number is something more like 5% of people.
That 5 is a bit of an underestimate, though, isn't it? Because because if I die and leave it to my wife, there's no inheritance tax there, and that counts as a sort of one of the no inheritance tax estates. Whereas when she dies, so it's slightly understated. I feel
that's right. And when we kind of looked into this a bit last year, we found that, not that surprisingly, you can kind of not quite, but almost double the number of people who are affected if you kind of think, well, even if I'm not going to pay, my partner is going to pay.
So as a unit, as a couple.
Yeah, if you're thinking about, yeah, exactly. On those terms, then a higher proportion of people are affected.
And of course, just to add to that, they're not only affected in terms of how much they pay. Lots of families will have been affected in the sense of having to do some tax planning, right? They'll have thought about it, they'll have worried about it, they'll have changed their behaviour to not have to pay it. So they're not going to show up in the numbers paying it, but they will have had some stress associated with the tax.
And also, even if you don't have to pay it, a lot of people have to report the estate to HMRC, fill out a lot of forms, and this might be a sort of source of stress.
I suppose the other reason that it might be unpopular is that people do observe that properly wealthy people don't pay as much as a fraction of their estate than they do.
That's right. And using some of the reliefs that, as we'll get on to, have been changed in the budget. If you get to the very wealthiest estates, 10 million and above, then the use of agricultural relief, business relief starts to actually mean that the percentage of the estate which is taken in tax goes down a bit for those very wealthiest compared to those with, merely 5 or 7 million pounds.
Oh, chance to be a fine thing. So we had a budget which inheritance tax played quite a role. Well, before we get onto the specific measures, one thing it is worth saying is that one of the things that Rachel Reeves announced was that the threshold for paying inheritance tax was going to be frozen for another, right through to the end of this decade, I think.
That's right, to the end of the Parliament,
and it's effectively the 325,000 number that Helen mentioned has been frozen since 2010.
Yes, I should know that number off the top of my head. But it's been frozen for a very long time.
So that's surprising. I'll ask Conservative government. I mean, older listeners of the podcast might remember George Osborne in about 2007 say he wanted to abolish inheritance tax altogether. That's supposedly one of the things that stopped Gordon Brown calling an election there. And far from abolishing it, he actually effectively increased it by holding that
That's true.
threshold constant.
They did in
cash terms.
Yeah, they did introduce the residence nil right plans, which had the effect of increasing the threshold for most, but not all people. That happened between 2017 and 2020. And so that took it up to the effect of 500,000 per person. But you're right that, looking over the broader swathe, that's been a reason, or will be a reason, why more people are going to be pulled into the tax going forward. And the OBR are forecasting now actually that the proportion of estates paying inheritance tax will reach almost 10% by the end of...
So pretty much doubling.
Yeah, yes, exactly. Doubling almost compared to the last financial year.
And your view is that we're going to get more and more money from inheritance tax.
That's right. So we actually think that perhaps the way that the forecast is done might even underestimate the amount of revenue that's coming in, because it's kind of based on projecting forwards how much wealth the people who are currently dying have. But we know that people who are a bit further out from passing on are much wealthier than those who are currently passing away. So we think that the amounts going through these estates and being passed on is going to increase quite rapidly in the coming decades.
Yeah, wealth is becoming more important to us as a country. It's becoming more important relative to income. People are inheriting more, so inheritance tax you'd expect will go up, particularly when you're holding those thresholds constant. And even what you're right, of course, that the 325,000 threshold, the effective threshold, has gone up because of the allowance for the house, but the 500,000 threshold, which was set in 2015, I mean, it's going to be stuck at 500,000 for at least 15 years.
Yeah, so I mean, it was phased in, but yes, you're right. We're going to have, I think, 10 years of or more of nominal freezing of that. So yeah, that's a long period of time in which wealth has grown a lot. So it's no surprise that more people are paying tax. Yeah.
And that's a big real increase in inheritance tax.
Yeah. Yeah, exactly. We're expecting actually inheritance tax to go up to 1% of revenues from the 0.7. So still not big, sort of dramatic sums, but growing and percentage terms, that's a big increase.
We sort of cleared. We spent the first 2 hours or whatever it is clearing the background conversation. Let's get on to so there were really 3 changes announced in the budget, weren't there? I mean, one was change to the taxation of pension pots, one was the taxation of business assets, and one was the taxation of agricultural land.
Yeah.
Well, should we actually start with pension pots? Because actually, I mean, that's got very little coverage. It's going to affect far more people than the farming thing.
Yeah.
So what's the change?
So before this budget, you could pass on a pension pot. Inheritance tax free. It doesn't even count as part of your estate. So people can always pass on their pension pot to their partner, or, as with all assets. But what's changed now is that pension pots are going to count as part of your estate, and therefore, if you pass them on to someone other than the partner, so your kids will probably be the most likely person, then they're going to count towards your total for inheritance tax. And if you're above these thresholds, you're paying 40% tax on that pension pot.
There's something different between 70 above and below 70 age 75, isn't there?
That's to do with income tax treatment
so that hasn't changed.
That has not changed. So
one of the reasons. So the previous situation was a bit absurd, wasn't it? Where you basically a pension became the best way of avoiding inheritance tax.
Yes.
We should be clear, we're only talking about the defined contribution pensions here. If you've got an old style defined benefit pension, then that just dies with you unless half of it goes to your spouse or something.
That's right. I mean, they can sometimes pay out some other benefits, which now actually will be captured by inheritance tax if they're going to someone other than the spouse. But the big thing in town is the DC pension pots. So yes, before this budget, if you were someone who was a pretty high earner and you went to a financial advisor, then what they might tell you to do is put money into your pension, and then when it comes to your retirement, draw down on your other savings, leave that pension intact until you really have to start drawing down on it, because if you happen to pass away earlier than you might expect, then that money can go to your kids inheritance tax free. So it was kind of used first and foremost by those with high levels of wealth as this inheritance tax avoidance vehicle.
So it's worth rolling back a little bit and remembering that this wasn't an issue until relatively recently, because until relatively recently you had to buy an annuity. When you got to retirement with your big pension pot, you bought an annuity and then it probably died with you. Then we had pension freedoms that let you basically have flexibility over your pot and you could choose how to use it. But the flexibility plus this inheritance tax thing meant that pensions were almost overnight stopped being the best vehicle to use to fund your retirement, which was the purpose, and started, for those who wanted to bequeath money, being tax avoidance vehicles. So it really changed pensions.
Yeah. And it's worth saying that was kind of discussed when that big reform was happening, and the government stated in advance that their intention was not that pension pots become inheritance tax avoidance vehicles. But at the same time as they did this pension freedoms, they got rid of a separate tax charge, which was kind of like inheritance tax for pension pots left over, which hadn't been relevant, suddenly would have been, but they got rid of it. And lo and behold, kind of very suddenly pensions took on this very different role.
So we think, broadly speaking, this is a sensible change. This is where you'll need to inform me. There's a wrinkle here, isn't there? So if you're over 75, there is income tax payable on your pension pot when you die.
Yeah.
And the worry is now that if you've got inheritance tax as well, this looks like a very big charge.
So the idea is really about how is the tax system treating people who save in two different types of assets. So the idea is, well, if I have saved into an ISA and passed that on, I've already paid the income tax. The person who receives it, they will not have to pay income tax on that. And they will pay inheritance tax on whatever the value of the ISA is. But if I'm passing on a pension, that comes not only with that big pension pot, but also the liability that you have to pay income tax on whatever you take out of it. So really, in pounds terms, receiving a pension is not worth as much to you as receiving an ISA. And so our argument was, well, really, ideally, the inheritance tax on that pension pot would recognise the fact that it's not as valuable to the receiver because they still have to pay income tax on it. Taking that into account is a bit tricky because we don't know how much income tax is going to be paid before the person's taken it out. But let's just say, well, we could assume that people are generally going to pay basic rate tax, 20% on that. Now, the way that you take that into account is to say that pension pot is worth about 20% less than it actually looks like. Let's apply inheritance tax only to 80% of the pension pot. That's one way of kind of recognising that difference. But as it is, the government has just gone ahead and applied inheritance tax to the full 100% of that pot.
So under what we understand the rules to be, you inherit, supposing it is over the tax threshold, you inherit £100,000 of pension pot, you pay 40% tax on that, so you actually get £60,000. And then if you're a higher rate taxpayer, you then pay 40% on the £60,000 when you withdraw it.
That's right. So yeah, in that kind of, that's the more extreme case where you're a higher rate taxpayer.
I mean, lots of higher rate taxpayers nowadays, but I guess particularly those who are inheriting quite a lot, probably more.
They'll be relatively better off people. Yes, that is true. So that's one possibility. So you could say that person's not fairly treated by the tax system.
So you could always say go one extreme to the other.
We kind of overshot slightly on that reform.
Arguably.
But I think it's still good to stop using pensions as tax avoidance vehicles. This is still a good move overall. I mean, there's some wrinkles they could have done a bit better than design, but And obviously, there'll be a lot of replanning now of people who've planned their whole retirements around this pot. They have to replan their strategies. But I think, having pensions be the vehicle you use to fund your retirement has to be right.
Yeah, I mean, it's absolutely nuts to design a tax system for pensions, which makes them the best way of avoiding inheritance tax. So, I think broadly speaking, that's that's clearly a move in the right direction. But there are some wrinkles about how this is treated for income tax. So let's move on then to what's happened with farms. I mean, that's clearly caused a lot of consternation in the farming community. So should we start with what was the situation as of before this budget in terms of passing on farmland?
So before the budget, there's special treatment for farmland. So if you owned a farm and used it as a farm yourself for 2 years, then after that, you could pass it on inheritance tax free.
What does it count? Maybe you don't know the answer. Using it as a farm myself. I mean, do I have to be the farmer on its combine harvester, or can I, be letting that out and using it as a farm?
So if you let it out, then you need to own it for at least 7 years, and then it gets the same treatment. You're free of inheritance tax.
Or rather, I mean, I can be a sort of someone who's invented a vacuum cleaner, for example, buy lots of farmland, and someone else does the farming, but because they're employed by me, I count as a farmer.
Yeah, exactly. I mean, whether or not you count as a farmer, you get the relief. So yes, and we all have seen reports about certain high net worth individuals who then take advantage of that, and that is one of the things which seems to be quite unfair about this relief. One of the reasons for trying to abolish or curtail it, and might also be a reason why the price of land is pushed up in some areas, because not only are people wanting to use it for that agricultural purpose, but also because it's a tax avoidance vehicle and it has additional value.
There's certainly some evidence of people making lots of money in the city, and they're essentially buying farmland, because that is a way of their descendants paying less tax.
Yeah. But that's pretty standard tax planning, right? It's not particularly unusual or exotic. It's if you've got lots of money and you need to find a way to pass it on. I think buying agricultural land or business property or AIM shares or shares that aren't listed is currently a fairly standard advice.
So there's in a sense, in our general sort of sense of we think that taxes should be relatively neutral, should tax different assets. Similarly, you can clearly see the case for moving away from, as you were saying earlier, Helen, this very generous treatment, because other countries sometimes have some additional relief for farmland, but they don't tend to just ignore it completely from the point of view of inheritance tax. So what about what's actually changed? We've gone from a world in which essentially farmland, no inheritance tax, to a situation where
you can now pass on up to £1 million combined agricultural land and business property. So that's $1 million on top of, as it were, the standard million that we were talking about earlier. Exactly. So you've the couple has $1 million. So if you think about an individual for now, as an individual, you can pass on $500,000, assuming it includes your home, and then you can pass on another $1 million in agricultural and or business property.
Completely free of tax.
Inheritance tax. And then anything above that gets taxed at 20%. So that's half the normal rate. So it's still very preferentially treated, both in the sense that you have a big allowance that comes on top of normal allowances, and when you do get taxed, you're taxed at only half the rate. But it's clearly less generous than the old system, in that now there are a group of people who would have been completely out of the inheritance tax system who are now going to be put in it to some degree. Obviously, how much individual estates actually pay is going to depend a huge amount on specific people's circumstances. But to give you a sense, if you have a couple and with some relatively straightforward tax planning, they should be able to pass on about £3 million free of inheritance tax, because they can both use their standard allowances and both use the £1 million allowance, and therefore do that. Through that, you can pass on a £3 million business effectively before you pay any inheritance tax.
Okay, so the £1 million relief, if you can pass it to your spouse, and then your spouse...
Well, actually, it's a wrinkle. You actually can't pass it to your spouse, but if you have children, for example, the first spouse dies, they pass their half of the farm to the children and they can use their allowance. And then when the second partner dies, they can pass their on. So actually, I think it's a good case to make it bequeathable, actually, to make it movable between spouses. It isn't. And again, some families won't be able to do that. Some families won't have a spouse, for example. But for those who do have a spouse, it should be relatively straightforward to pass on, to use both of the allowances.
Okay, so how many people is this going to affect year on year?
There's definitely some uncertainty around the exact numbers, but HMRC and the Treasury have put out some figures in terms of how many people will be affected,
and that's based on how many people actually use actual agricultural property relief.
That's right. So they see in recent years when people are filling out their inheritance tax forms, they make a claim for these reliefs, and they're fairly confident that where people are eligible for these reliefs, they're fully claiming for them, and so that gives us a good sense of how much of this wealth is out there. And what they say is that taking those claiming for agricultural relief, first of all, in recent years, about 1,700 or so people or estates, are claiming for that relief each year. And they think that about 500 would be paying additional tax as a result of this change.
So 500 each year are effectively at the moment claiming more than £1 million worth of agricultural relief.
That's that's right. That's what the recent data is based on. There's then some forecasting into the future and quite a lot of moving parts. But the thing you want to take away is that that's the magnitude that they think. A bit more than a quarter of those who are claiming some of the relief are going to have to pay some higher tax.
And of course, worth saying that's in some ways it's a good. That's really an upper bound almost, because that's before we think about how people can respond to this tax. So if you respond and actually you are in a couple, and not all farmers are, but if you are in a couple and you can both use your allowance, you won't have to pay that. Or if you can give your farm to your descendants 7 years before you die, you won't be in this inheritance. So this is kind of based on the who's claiming it recently. The system has changed. People get new advice. They should get new advice, and then they can change. So
an absolute maximum, we think, and this is based on data of people actually using agricultural property relief, absolute maximum of 500 a year. And it's worth saying about 500, bit more than 500,000 people die every year. So this is one person in 1,000, just to give a sense of scale here, who might be affected by this.
Yeah, that's right. I think, to be fair, or sort of casting things in the, an alternative framing, would be, those who say, well, out of those who have a farm and have a farm of at least substantial size that actually is a viable business, this could actually be a far higher fraction. So that the claim coming in, which I think there's some merit to anyway, is that in that estates data, you're seeing quite a lot of, small holdings, maybe sort of hobby type farms. They're all in there. That's not kind of only serious businesses.
Yeah.
So we can't really put an exact number on it, but if you were to kind of restrict to that group, then perhaps the fraction affected or potentially affected, depending how they manage their affairs, could be a fair bit higher. And I think that's where there is some kind of trading of figures in the public domain at the moment, and that's kind of the essence of it. That's where the argument is lying.
And the argument the farmers are making is that because it's a block of land, I give it to my kid. I mean, I leave it to my kids. Maybe it's worth £5 million, but and you've got to pay 20% on 2 or 3 million of that. They've got an asset worth £5 million, but they don't have the cash to pay it. I mean, that is basically the argument against, isn't it?
Yeah, it is. So I think there's kind of two different things. One is just a liquidity problem, right? So one is actually you think that you're sitting on a £5 million estate, you're clearly wealthy by any definition of the term, but you just haven't got the cash to pay it. In that case, there are some things you can do, like you can save in advance, knowing you've got a big bill coming. Once you do have the inheritance tax, once you've actually died, your estate has 10 years to pay the bill. So there are things you can do to help get around the pure liquidity issue. But yes, there are going to be some farms for whom it's not purely a liquidity issue. It's they think they can never do anything. They can't even borrow. They can't. 10 years wouldn't be enough. They can't get the cash out of their farm, and therefore they might be in a situation where they have to sell a part of that farm, or maybe all the farm in the extreme. I think we're talking about small numbers here, but it won't be zero. I think one thing worth stepping back and saying is that already happens for some people. For example, you might inherit a main home. Maybe your family have had a home in London. It's risen a lot in value. You inherit that house. You might then be very asset rich, but cash poor. You can't afford to pay the inheritance tax bill. At the moment, there are people who have to sell their homes, to which they might have very sentimental attachment. I'm just pointing out that it's not special to farms. It's a feature of inheritance tax. So I think one can completely hate inheritance tax, and many people do. I think the question is, if you're going to have an inheritance tax, and we do, I think there is problematic to treat some assets differently to other assets. So yes, there will be farms potentially in this category, or I do think it's a small number. But that isn't singling out farms for special bad treatment. It's almost bringing farms more in line with other assets. And again, they still got preferential
still
treatment.
more generous than so the argument that then the farmers or farming lobby will put back would be, well, what about food security? If you maybe sell my farm, there's going to be no more farm. Now, presumably, that's not the case. You presumably find someone else who buys the farm and probably continues to farm it.
Yeah, I guess so. I guess the question is, well, who's buying the farm, and what's the most profitable, viable use of that land? Now, if it remains farming after this change, then perhaps the same person even is working that farm, and maybe as a tenant rather than the owner of the farm, or maybe someone else is working the farm. Now, if the issue, as it's seen, is that, well, someone else wants to buy that land and use it for something else, well, that's really a question for us or society, for government, is, are we happy with that change? Is it that actually there is something better that can be done with the land, and that's why it has a price that farmer cannot afford to pay by farming the land? And if we're not happy with it, changing use or not being used as a farm, then I think that would take us towards not doing this tax change, but saying, okay, we actually want to subsidize explicitly farming in general for some other reason. And that's something that we're going to have to do in order to promote farming beyond what is apparently viable at current prices.
I mean, to add to that, I think the story we often hear, and obviously it's the story that's going to be put in the papers, is of the family farm that's very productive, that's doing great. They might have to sell their farm, and isn't that awful? And I thought that might exist. But another story you could tell is about the really rich, high net worth individuals who buy into farmland and push up the price of farmland, not because they have some innate passion or any skill at being farmers, because they're using it as an inheritance tax vehicle. That wasn't the purpose of the relief. We should get them out of the relief.
And it also makes farms more expensive of real farmers to buy.
Oh, exactly. It's
Price of the
stopping
land.
Who's getting a farm. What you'd like is the government not to be distorting who owns the farm, right? You'd like the government to almost be agnostic as to who owns the farm and who farms the farm. At the moment, there's a big tax advantage for keep it in the family. So families are the most productive ways to do farming, great. But if they're not, the government shouldn't be discouraging family farms. It's not clear you want to be encouraging them on a basis. I don't think you can make a productivity argument that they must be more productive and therefore we must subsidise them.
I'm sure you can't make a productivity argument. I think the point is that people who have got family farms feel very emotionally invested in them. But as you say, so do people often who have family houses, but they're forced to sell when a parent dies. And from that emotional investment point of view, yes, of course, one understands why farmers are going to be very upset about this, but it's only moving them sort of less than halfway towards where people with other sorts of assets, and particularly homes, already are. And hence, the argument may be about food security, maybe about looking after the landscape and all those sorts of things. And if that's the issue, as David says, it's not obvious that the inheritance tax is the right way through it. But should we move on to that question about business property relief more generally? Because in some senses, the agricultural relief is a special case of business property relief, where actually quite a lot of the same issues exist. Because again, broadly speaking, we've had this system in the UK where if you own a firm, if you own a company and you pass that to your heirs, up till now, again, no tax. And actually that's gone rather further than that. If you own shares in unlisted companies or shares on the AIM market, again, no tax. And again, I think this is really quite unusual internationally and has clearly been used as a tax break.
Yeah. So there's some changes that have been made there, as you say. So this new limit of £1 million applies to combined business and agricultural relief. It's worth noting that those AIM shares, so that's basically a type of share which is not listed on the regular stock market, but I think from the perspective of inheritance tax, really shouldn't be treated any differently. That does not get any of that special relief, but you do only pay 20% inheritance tax now on those types of shares, where previously you paid 0, so they're still preferentially treated.
Okay, so it's still worth buying AIM shares to reduce your inheritance tax.
It's still a way.
So this is not a financial advice podcast, by the way. I should say to anyone listening who is thinking about their inheritance tax, please speak to a proper financial advisor.
Yeah. But I think that there's there's a set of kind of arguments that I'm sure we'll maybe get into a bit about that people make anyway for business relief about, again, similar to the farmers, family businesses, breaking up businesses and problems with paying the bills. I really don't think that those apply to things like these arm's length held AIM shares. And so, we've gone in the right direction, but I think really that should be fully scrapped and there's not even an argument to be had there. But when it comes to sort of, let's call them family businesses, then we get into some of the similar arguments that we've been outlining with the farms. But again, it really ought to be the case that there's ways that people could meet this tax bill if they want to do that and they want to retain the business, and if they decide that it's not worth their while holding on to that business, or it was only worth doing that because of the inheritance tax break, then that's probably not something that the government should be promoting.
Okay, so we've looked at how many farms might be affected every year by this change in agricultural relief, to which the answer is we think fewer than 500 a year. What about how many businesses are likely to be affected?
Yeah, well, if you use the same HMRC data looking at who's actually claiming relief, so at the moment there are about 4,000 estates that are claiming business property relief, and HMRC think that actually fewer than half of them will end up having more than £1 million in assets and therefore potentially being subject to this extra tax. Of course, again, how many actually end up paying will depend on how they can rearrange their affairs and whether they can pass their businesses on in life, for example. But think of something under 2,000 businesses. So it's bigger than agricultural relief.
Well, these are still very small numbers.
Yeah,
in the grand scheme of things. I mean, obviously,
if you're one of the ones affected, then it's going to feel big to you. But but we're talking about relatively small numbers of families having to deal with
this. And again, it's an interesting lesson, isn't it, in how effective or how problematic it can be to change a tax, which might affect, actually, as you say, in the population, a very small number of people, but it really worries that group of people. And for some of them, it really will be a big issue. And that makes it a big issue politically, even if from an economic point of view, the numbers are disappearingly small.
Yeah, I mean, I think it's the revenues raised, they're not very big, really, as we've said. But it's coming from a pretty small pool of people. You might say, why would they do this from a political perspective? I think, there's an economic rationale which says that if you're going to try and clamp down on some of these reliefs, then you need to do that quite comprehensively. So you can't really kind of carve out some small group, because then that will be the hole in the tax system that people start heading through.
Yes, if you clamp down businesses but not on agricultural land, you're going to put more pressure on agricultural land to use that as an inheritance tax avoidance vehicle.
And of course, it fits quite nicely, I guess, in the ideology of those with the broadest shoulders, even if some of those affected really don't feel their shoulders are very broad at all. And
it's true. I mean, it is true in the sense that if you're going to end up paying inheritance tax, you have to have been sitting on a pretty big asset that does make you kind of wealthy. You might be cash poor, but if you're going to be in this system, you by definition, you have to have had quite a lot of wealth.
I suppose what they would say is, I've got this business, it's worth £10 million. All else equal, it would remain as a £10 million business, but I'm passing it on. There's a £1.5 million tax charge on it, or whatever it will be. The only way of paying that is to break up the business, and so the government's interfering in the structure of the economy, and that's inefficient. I mean, it sounds like a reasonable argument.
Well, I think it's only a partial argument, because you could similarly say there's a business that's being held that actually would have been better had it been sold. Actually, maybe the current owner is not the most productive owner of that company, and it would be better if it was sold to a different owner, but it's not being sold to a different owner because it's being held onto as an tax avoidance vehicle.
And a capital gains tax avoidance vehicle as well.
Yeah, exactly. That's another wrinkle in this whole thing, because we forgive capital gains tax at death, as we talked about in a previous episode. It's kind of a double whammy reason to hold on to these assets. Or you have people, who are just buying business assets, again, in order to pass on these assets. So I think it goes both ways. The government is basically distorting who holds on to assets. So you have to think
by treating them differently, not by introducing the inheritance tax, but by treating different things
by treating them differently. By having you have an inheritance tax to start with, and you treat different assets differently. You are favouring some assets relatively to other assets, and therefore the government is already getting involved in who owns different assets. So the question is that working, and should they be doing it in the first place? So is it working? Well, yes, I'm sure you can find me some examples of productive family businesses who haven't got to be broken up now. Great. But you can also find examples where actually it's doing the wrong thing. It's getting the wrong owners into that business, or it isn't being sold. So it kind of goes both ways in that sense. And then should they do it in the first place? Well, actually, if you look at the kind of evidence base, and obviously this is not about an individual company here, you look across companies, it's companies that are family owned and run by a family member, especially those where they've been inherited, actually tend to have the worst management practices. They're the least productive companies. Not all of them, obviously. You'll find examples that buck that trend. And that kind of stands to reason if you think about it. If you think about a company who's kind of gone out to the market, found the person who's got the skills to manage a business, it stands to reason that they're probably going to be more productive than somebody who just happened to inherit a company. Not always, but on average. So if you were starting from scratch and saying, should the government skew the ownership of firms towards families and people who inherit businesses, the answer is no, there's not a very good case for that.
In a world where it charges inheritance tax on everything else.
Yes, exactly. Yeah, so if you're gonna just add a distortion, I mean, ignore inheritance tax from it. Just say, do you want to distort the ownership of businesses towards family businesses? I think the answer is no. You don't have to discourage them, but you don't want to distort towards them. So then the question is, if that's your principle, why do you want an inheritance tax that does distort towards businesses? I think the answer is you don't. Now, again, it's still going to be the case, to come back to your original point, that you'll be able to find a business who's productive, for whom this change means now there'll be some inheritance tax, maybe you have to sell your businesses. And you think that's a really bad thing. But if you think it's a bad thing, that's a function of the inheritance tax per se, as opposed to this new change. So there's some subtlety there, but I think we're just saying, if you're going to have one, don't treat things differently, and then you can argue separately about whether you want one or not.
So I think in the end, the conversation we should be having is, do we want an inheritance tax? I'm pretty convinced that if you're going to have an inheritance tax, then you should treat as many assets as similarly as possible, because if you don't, you both introduce inequity and you introduce quite a lot of inefficiency because of the way that people hold on to assets or buy assets or increase the value of the assets because of the inheritance tax treatment. So in that sense, the movement of business, farms, pensions to the same base as everything else. I mean, we should finish in a minute, but I suppose the final wrinkle on all of this is that the truth is, it's all really quite easy to avoid anyway, isn't it? And again, if it's genuinely a family business or family farm, pass it on 7 years before you're going to die. And you don't know when you're going to die, but take out a bit of life insurance in case you die before 65. Yeah. Pass it on then. I mean, there are not. It's a pain, and this is one of the things that is created by inheritance tax that lots of people have to deal with it. So it's not a great argument in favour of making these changes, but it is a sort of a lesson in how things get more difficult when you do have an inheritance tax. You don't have a lifetime gift tax, and you have other ways of not paying this. I mean, be healthy, wealthy, and well advised.
Yeah, I think that's absolutely right. And some people will probably shoot back. Well, look, I don't have time. I'm almost at the end of my life. I'm not able to do all the things that you're describing. But that's a problem that's come about because we've had this old regime in place, and now we've got to make this switch, which is going to be, of course, painful in the transition. So, this is an argument, I suppose, not doing it in the first place, but also having a well-designed system that people can rely on and plan on the basis of, that we don't need to be changing in this sort of way. And at the end of the day, it still remains that, if there are people who in that transition, it's going to be potentially very difficult for them for a range of reasons. Maybe they can't fully get around all of the issues and using the things that we've described. But that's not a reason for not making this change. Ultimately, we need to, we want to anyway, get our tax system into the best shape. And if you're concerned about people affected on the transition, then you need to kind of deal with that directly. It's not an argument for not doing this change.
Yeah, that's a very good point. Actually, there will be a small group of people for whom this change happens at exactly the wrong time, that they are unfortunate enough not to have done any of this planning and to be old enough to expect to die, or actually to die before they get a chance to make those changes. And in effect, they will be much worse treated than will be the case in equilibrium.
That's right, because they've not had the time to kind of plan and buy that life insurance or make those lifetime gifts. So you could maybe make a case that it's a political choice, but maybe there's a case that you could make for compensating some of those people but that's for the politicians.
Also, I don't want to push this too far, but for some farmers, this is kind of good news, right? In the sense that if you are a farmer that's actually can plan around this in one of the many ways, a bit of life insurance, a bit of, having a couple, splitting the assets, passing your farm on. And actually, if one of the things this does is help get some very rich people out of kind of buying farmland as avoidance vehicles, then that might at least take off some pressure on the price of agricultural land and kind of make agricultural land something that farmers buy and not people who are just rich. So for some farmers, once you've got through the stress of having to deal with this situation, I think actually part of this is the problem is that farmers are probably hearing, oh my God, this is the end of family farms. What do I need to do? So there's some sort of stress of going through, working out how it affects your individual family. But I think for some farms, this actually be good news, ironically.
For someone who wants to expand, or, I guess the people who we won't hear from are the people who aren't yet farmers, or who, aren't even at the point where they aspire to become a farmer, but in the future might want to. And if it is more affordable to do so, then they're slightly more able to get into farming, whereas potentially the current system is shutting a few of those people out. And that's a general point about inheritance tax, is that I guess we can't hear from the people who might be benefiting from the fact that some of that wealth becomes easier to access.
Absolutely. Well, look, we should probably end this. It's been a fascinating discussion about inheritance tax. I think we've come down to some extent, a discussion about some of the downsides of inheritance tax on anything, because it is bound to change people's behaviour, and it clearly for some people with a bit of wealth, they invest quite a lot of money and time in managing that, and there's in that sense, unproductive industry. I have people who help people to avoid inheritance tax, but the arguments for treating different assets differently is really, they're really quite weak. We can understand, of course we understand that people who benefit from these at the moment are going to complain about change, and there will be a small number of people who we might be worried about losing from this, but the broad long-term impact does look like it must be broadly positive for the tax system, and indeed for business and farm ownership, and for the way that we treat pensions, let's not forget. So we should, as I say, end there. Thank you to David, thank you to Helen, and thank you for listening to this episode of the IFS Zooms In. To see more of our work, please visit www.ifs.org.uk, and to further support us, please consider becoming a member for as little as £10 a month. You can find out more in the episode description. We'll see you next time.